But we'll discuss this in greater detail. For now, let's take stock of the Q3 earnings season, which is upon us. It starts with TCS and Tata Elxsi on Thursday. Prateek Parekh from Nuvama Group is joining in to discuss the market fundamentals. Prateek, morning, and thank you very much for joining in. Now, Q2 was a rough quarter, a tough one. We saw a lot of earnings downgrades. What is the investor positioning and expectations going into Q3 earnings season?
Yeah. Hi, Rima. Thanks for having me over. So I think if you look at Q3 earnings, so far, the feelers that we have got seems to be a very similar to what we had in Q2. Top line recovery, which everybody is expecting, is getting delayed. This is likely to be the seventh straight quarter of sub 10% top line growth. And for profit growth as well, for our coverage, excluding the volatile OMCs, the growth rate is going to be around 9%. So, which is very similar to what you've seen in H1. And clearly, if you look at the consensus earnings estimates for F25 and F26, for H2, they are forecasting mid-teens growth. So from where earnings expectations are built in, I think clearly there is going to be more likely downgrades that are going to come through. But nonetheless, if you do the investor positioning to some extent is already ready for that. But I think the earnings recovery is proving to be elusive. And that, I think, is a source of concern and I think a key monitorable for the year 2025 itself per se.
So what's the extent of earnings downgrades? What is the Nifty EPS estimate for FY25, FY26? What could it be scaled down to? And in Q3, where might the earnings disappointments come from?
Yeah. So I think if you look at the Nifty earnings for 9-month FY25 based on our preview numbers, we are likely to be around 3-4% range. The full year forecast is around 10-12%. So I think most likely we'll end F25 in single digits. For F26, the earnings forecast is in mid-teens. This is likely to be pruned down. And, the way things stands, you will again, in most likely in F26, get a single digit growth. The simple reason is that the margin tailwinds are no longer there and demand dynamics is still not very, very conducive for a big growth because credit growth is slowing down, exports are weak, and the policy support that is needed is not there. Once the policy environment turns stimulative, I think we can see a better earnings outlook. But until then, earnings downgrades are quite likely. The downgrades are likely to be more pronounced in commodities. Banks' earnings should hold up, and to some extent in the consumer space, where the recovery is, keeping on getting postponed of sorts per se.
Understood that. Prateek, one thing which we want to understand is you've spoken about how H2 is expected to be slightly better. FY26, you're expected to be a single-digit earnings growth. Now, going into Q3, how do you see market positioning as far as various sectors are concerned? We'll be starting off with the IT sector earnings soon. So how are you positioned there? And what do you expect, what could be the key upgrades or downgrades coming in as per your assessment?
Yeah. So I think we've been very bullish on the IT space for most of last year, and the call has worked very well for us. Nonetheless, we recently downgraded IT to neutral. This is again a tactical downgrade, and the simple reason is that valuations have really caught up. Valuations in the space have reached the levels that were last seen in 2021 end, and at these valuations, the margin of safety is very low. Small disappointments can lead to big derating. And that's where in IT as well, I think the base case is a stabilization. But nonetheless, small misses on that front, given the way the sector has done well last year, could lead to very wild stock reactions of sorts per se. And we already saw that where despite Accenture's positive guidance upgrade, IT stocks have actually corrected, which tells you that investor positioning is already very heavy on that side, and the room for disappointments is very low per se, Vivek.
IT positioning is high, room for disappointments is very low. Prateek, on banks, now Q3 banking updates came through yesterday. Were they in line with your expectations? Because some attributed one of the reasons for the fall. We were all looking for excuses for yesterday's fall, and they said, well, the banking updates were nothing great, perhaps even worse than what the street was hoping for. So talk to us about what we heard and saw yesterday.
Yeah, I think banking upgrades were broadly in line. I think the yesterday's move is not so much because of the updates, but just the broader dynamics that from here on, the domestic liquidity has become quite tight. And unlike the past 2 years, where India has decoupled from EM, we have had a very good run in equity markets, especially in the cyclical sectors. I think the macro setup is now changing. We are now in 2025 going to be more closely correlated with global events because our domestic liquidity has tightened. And if INR does come under pressure, it does raise dilemma for RBI. Because on one hand, if they defend INR, they drain domestic liquidity, which hurts the overall risk appetite, and that's where I feel that I think the yesterday's correction and 2025 in general will be shaped more by the global events, and especially the call on dollar. To that extent, will be very critical in shaping next year's returns. Per se, Rima. It's not got so much to do with updates because updates I think are broadly in line, and in fact, banks' valuations are also not very lofty. In fact, that's one of the very few spaces where valuations we find are still reasonable. It's just the macro development that is going to be more critical per se.
Prateek, we get that point. So within banks or within financials, where would your preference lie? Is it the private financials, private banks, or will it be the PSU? And within NBFCs, do you like any stocks that you feel, at this point of time can be entered into?
Yeah. So, I won't go in the stocks, but I think within the financial space, we are owing large private banks. And also insurance companies. We are neutralish on PSU banks and underweight NBFCs. And our simple rationale is that typically, if you look at the large private banks and insurance, despite them being cyclical in nature in the past, they have proved to be quite resilient during downturns. In fact, we have highlighted in our report that during the past 3 or 4 credit slowdown cycles that we have seen in post-GFC world, private banks actually have outperformed during downturns. Not only that, their PPOP growth has actually accelerated during downturns. Simply because these franchisees are a lot more quality in nature, and in downturns they are able to price loans and focus on profitability better. So I think private banks do make a case despite growth concerns to be overweight, and valuations over here also are very reasonable, not just relative to market, but also on absolute basis. And that's why we feel private banks and insurance are the spaces to be having. PSU banks, clearly the balance sheets have improved and the franchises have become a lot more better in quality. So to that extent, they mean the typical underperformance that you get may not be very large this time, but clearly here as well, credit costs are at the bottom, and small swings in credit costs can weigh very adversely on profitability. So perhaps even over there, a big overweight may not be warranted. And for NBFCs, the whole regulatory tightening, liquidity tightening, and potential rise on the, if any, on the retail stress, I think NBFCs will bear a bigger brunt. And that's a space where we are relatively a lot more cautious per se, Vivek.
So just one quick word from my end. It was a 4% Nifty EPS growth in H1. For H2, what would that number be?
So for H2, I think the consensus forecast was around mid-teens. That number will most likely be brought down, after this quarter's results come through. So far for 9 months, if our preview numbers are met, we should be around 4-5% growth, around 4 to 5% growth for 9-month F25. So clearly the full year F25 numbers will need to be marked down per se.
Prateek, moving to one particular sector that's done very, very well, especially in the last month or so, it's the healthcare space, the pharma space, and in the last couple of days, even the diagnostic space. Now, as far as the pharma space is concerned, there have been a couple of sell-side analysts who've been calling that maybe this year and first half of next year, you could see a bit of a cliff coming in as far as key generic companies are coming, where a lot of companies, which are enjoying exclusivity, will see patents fall off. So on the back of that, how do you see, markets pricing in the entire healthcare space? Do you still like any names over there, or do you still like any specific pockets of the market? There has also been a lot of optimism as far as the CDMO pocket is concerned.
So I think pharma is one space that again we have been overweight and it has worked very well. Now here as well, yes, valuations have caught up, and to that extent, the margin of safety is lower. But nonetheless, where we still think pharma, warrants an overweight stance is because while there is, a patent cliff coming in, but also at the same time, these companies, have spent quite well on R&D. Going ahead, you will see companies moving up the value chain and some of the R&D spends done being monetized. So the earning downgrade risk, I think, in pharma is probably one of the lowest amongst the pack. And to that extent, while valuations are high, an overweight or case is still warranted. And that's why we still like the pharma pack as a whole per se, Vivek.
Understood that. So going into this particular earnings season, if you could quickly wrap up, what would be the spaces where you feel there could be beats coming in and the places where you feel misses could come in, that we could leave it on that note.
Yeah. So I think more than the earnings season, if one looks at the whole year perspective, I think this is the year of capital conservation. We think for this year, that is the key theme. We would rather buy into franchises which are quality in nature and valuations are reasonable. We are overweight private banks. We are overweight telecom and internet because we think the cash flow certainty is quite high. Pharma and cement. And we are quite underweight the whole cyclical pack, where we think, given the demand uncertainties, the downside risks are much higher per se than it.
Thank you so much, Prateek, for joining us, giving us your sector review expectations going into Q3. We wish you and the team a very happy 2025. Thanks once again. Well, moving on now, this is our special segment, Quarter Say Quarter.